Good day, everybody, and welcome to the fifth edition of the Smoking Barrel. I'm Rustin Edwards, based here in Geneva, with my illustrious co-host, Mr. Matt Stanley. Good
And his
morning.
new golf clubs. Just, I'm going to send them back. They don't work.
Your handicapped got more handicapped.
Yeah, it's just stupid game, but I love it. No, greetings, one and all from the desert. You sound so crystal clear, Rustin. Is that a new microphone I hear before me?
There has been some investments made on the Smoking Barrel website. So yes, new microphone, new light. So everything's crystal clear and Bristol fashion, as they say.
Well, keep on adding to that demand, mate, with all these new lights and, gizmos.
Somebody has to do something to help spur demand because China certainly isn't doing it. Neither is the United States.
It's odd, isn't it? It's yeah. Look, again, I know this is the theme this year, viewers, about the wait and see what's happening, but I don't know. I think we've got to wait another 3 or 4 weeks before we really see some data coming in. What is happening with Russian exports? Crude obviously is in its second month now on the embargo within the EU. But I mean, look at India. India again with Kev, our good friend Kevin Wright. He wrote a piece yesterday about the relationship between Russia. Well, what did he call it? Russia and India, a happily arranged marriage, which I thought was very poetic. But yeah, I mean, look, the amount of oil that India are buying from Russia, I'll get up the latest data. Not a plug, not plugging, just saying that if you want a system to monitor flows. Yeah, look, January, India imported 7.5 million tons of Russian crude and products. 6.6 of that was crude. They did 250 KT of fuel oil, 200 KT of straight run. So I think that trade pattern is clearly formed now. I don't think that anyone can deny that. It's not being hidden, and they're not doing anything wrong by buying Russian oil. Apart from, again, what I've said, that where it sits on the moral compass and what it means for political pressure is different. But to put that into context, in January 2022, India in total bought 450,000 tons. Last month, 7.4 million tons. So it goes to show you that homes are there, outlets are there. Africa, I'm certain, will be a big buyer of the naphthas and the gas oils that Europe were buying from Russia. I think. I don't know. I was talking to someone yesterday. I mean, what's your thoughts on that? Do you think that? I mean, if you're sitting in one of the big traders, a Vitol or a Trafi or a Glencore or wherever, is that a problem for Northwest Europe trade, that Russia will just go directly and bypass that? What has historically been a massive trading hub.
Well, I mean, I don't think it's a problem. It just rebalances the market. So, prior to the invasion, Europe exported gas oil into West Africa and Northern Africa on a fairly large scale. And so all you're doing is see a replacement of that barrel flow. Instead of coming from a European refinery, it's coming from a Russian refinery. And then the European refinery is there to backfill what they would normally receive from Russia on inflows into Eastern Europe. So net, you probably keep the European market in balance at the current refinery run rate. And so you don't really see a major shortfall in supplies.
No, sure. In terms of the balances, yeah, I completely agree with you. But I'm just talking in terms of the trading community itself. Where the trading community sitting in London or Geneva or Paris or wherever it may be, that they can no longer touch those barrels, the Russian barrels, and those Russian barrels themselves are going direct into markets they were supplying. Is that a problem for the community in general?
No, because I think the traders will always figure out another trade. I mean, so if you're not going to supply oil from Russia into Africa or from Europe into Africa, one trade that I have seen develop, or that continues to develop, there is the export arb of gas oil from Asia into Europe. So you do see traders changing their focus, saying, okay, that is where the next arb flow comes from, or from the United States into Europe. And so you just supplement that trade with a different trade flow, and you focus on different sourcing markets and rejigger your business. So I think traders will do that. I think they've done it. And those fruits of those labors will either make themselves known here in the next 4 to 6 weeks as we get out of the winter burn period into the summer. We'll see how stocks adjust in the EU accordingly.
Yeah, because look, I mean, ironically, whatever Europe was doing, the opposite of a rain dance, was doing a warm weather dance, because the winter has been incredibly mild.
It's been mild. And so the call on energy never developed that everybody was fearful of, thank God.
Yeah.
And with that, natural gas stocks were never really drawn down. Gas oil stocks were never really drawn down. And so now we've gotten into a situation where product stocks are, albeit still on the lower level, are still relatively healthy. I mean, they're not swelling the tanks full, but it takes a few arb cargoes. The next thing you know, we'll have an oversupplied gas oil market in Europe.
Well, okay, but let me ask you this then. Is that a case of Europe got away with it? It's papering over the cracks. Those issues are still very much there come Q3 next year for winter buying, or this year, sorry.
I think it's a case of how strong can the European refining sector run? What do they do with their own internal production? And what is made up net from the arb flow coming in? I mean, if Europe's not exporting gas oil to Africa because Russia's taken over that business, then that gas oil molecule has to find a home somewhere else. And gas oil molecule stays in Europe, as far as I can see. It doesn't need to go anywhere. So then that
you're right, yeah.
That volume from Russia. So going into the next winter, when you look at natural gas stocks, I mean, I think they've got Germany's put another nat gas import terminal up and running. So now they have 2 and they're building more. I mean, so they've accelerated that piece of production. So I think they'll have the nat gas flows settled. And once you stabilize the price of natural gas, that just rolls back into all your other economic activities and your refining sector, and therefore makes cost of production drop. And so I think you will see negative pressure on the cracks in general, just because that whole cost of producing is going to keep coming down. I mean, I think part of the move on gas oil cracks here in the last 4 months has been the fact that natural gas prices, if you look at it from where they were at the beginning of Q3 last year to where they are today, I mean, it's been a massive pullback on natural gas prices.
Yeah, it has. It's I'm just looking at one of the charts here from looking at it on the 1 year. Yeah, I mean, look, it got up to natural gas futures. What does that trade? Per million BTU?
Yeah, BTU.
So 930 per million BTU at the middle of August, got up to just under 10, and now it's 240, miles lower than pre-conflict. So yeah, I mean, look, it's a 3-year low. No, I think you're right. I think that the fundamentals have not gone the way that most traders thought they would. And the oil market is very capable of getting ahead of itself. Arguably, that's when traders take risks. Traders take positions based on a pessimistic or an optimistic forecast with enough logic and rationale and data behind it to justify the decision. Speaking from a trader who may or may not have used that very same sentence when he was running a book that was losing money. But I agree. I think, again, I know the rhetoric's the same, but arguably oil markets being stuck within this range that I have been, a fairly narrow one for the majority of the year so far, we're trying to explain it or give our thoughts around it, why it's stuck in this range. And it is because things haven't panned out how people hoped. I still think there's support on crude at $80. The big funds are still looking at that. There is the risk of supply. The Chinese demand story is a bit meh, I don't know.
Yeah, but that's what most of the people are betting on. Everybody's betting on China demand coming back. China's going to save the world. And let's ignore everything going on in Europe and the United States for the time being. The fact that demand for petroleum products is pretty poor. It's the future prospects of a China full-on economic recovery, bringing demand up to levels that are accelerating above where they were in 2019.
Yeah.
Which, if you take that into consideration, pre-COVID, the Chinese economy was in a downward glide path. Their oil demand was dropping. Their GDP was dropping. They kind of reached an economic saturation point. And now we're expecting them to come back greater than they were before. And I just don't know if that's going to materialize. And you know, I always like to look back at where freight sits right now, especially on dry bulk freight and container.
Yeah, yeah,
And those two
yeah,
markets are
yeah.
completely
I want to
negative, or they're negative earnings.
Yeah, I want to talk about freight in a minute, but on the China story, it's interesting because I'm looking at data points that are coming out all the time, and one of the data points I look at is what's happening with people and moving, and how they're moving and how often they're moving. And DXB, Dubai Airport, announced its numbers for last year this morning, and it's always relatively interesting because it's a tourist hub. Obviously, last year was a big one for the Middle East in terms of sporting events with the World Cup in Qatar. That was a success, total success.
Well, and also you
So,
had a massive flow of refugees from Russia who decided they didn't want to take part in the war.
well, there's that, but I'm not going to comment on that. Thank you. Yeah. Look, they're still below pre-COVID, and they're doing well, and they're surging, and DXB is busy. I was there. I was in Riyadh last week. And it was, Dubai Airport was busy. It was very busy half term. And when I think about it and listening to Paul Griffiths, who's the CEO, he was on a radio show this morning. He said 15 to 20% of tourism that goes through DXB is sourced from China. Now, that is a gargantuan amount of demand that has got to come back. So the noise around the Chinese demand story and why people are placing money on it is because it is a big story. And even if half of that 15 to 20% of footfall that goes through DXB comes back, it still does justify a rise on flat price.
Except we have large stock builds around the world.
That's okay. I mean, look,
whatever. It's one thing to say that you're going to have forward demand of something that's going to happen, but until the demand actually materializes, the market is way overpricing China's recovery and the extent of the recovery. As you said earlier, petroleum markets tend to get ahead of themselves, and I think the market in general has gotten ahead of itself in saying that China's demand is going to be so massive. It's almost as if the OPEC, the IEA can't beat each other on how much Chinese demand is really going to impact the entire world. And we saw how IEA's prognostication around Russian oil flows panned out when they were
you're right.
estimating 3 million barrel cuts in crude supplies, and then that didn't materialize. I almost think that maybe they're falling under a cognitive bias of how China used to be 3-4 years ago, and people can't get their heads around that maybe China's not that strong as it was 3 to 4 years ago.
Yeah.
That was actually the last real data point that people had to work with.
I know. I mean, look, like I said, China opened, it seems like a lifetime ago now, 7 weeks ago. We're 7 weeks into the year. China reopened to prepare themselves for Lunar New Year celebrations, which was 3 weeks ago. So there's still, I wouldn't say that the claims that Chinese demand is roaring back are false. I'd say it's just too early to opine. And okay, are you going to start seeing large drawdown of stocks? Look, I think floating storage, offshore China, I think that is started to come off. Not, on land, we saw EIA data last week, a 16 million barrel build. Sorry, Gov, not my fault. It was an admin error. There was some calculation that was messed up from the week before, but anyway, market largely shrugged it off. But I think in about a month's time we can start really looking at the data and then criticizing it, looking into it in more depth. Will we see it? I don't know.
To me,
China,
it comes back to, as I said earlier, what's the actual forward freight markets looking like to supply the raw materials and the finished good raw materials into China for production and finished goods out of China? And if container freight is still at negative earnings, minus $2,000 or $2,000, not minus, but $2,000 to move a box from Shanghai to Europe, and dry bulk on Cape Maxes at 25,000 a day, or sorry, 2,500 a day. That's not stellar earnings. It doesn't show you that there's any real demand to move raw materials in nor finished goods out yet.
I know, but look at the number where freight has come from. Tanker earnings are still good. December 2021, and they were very, very poor. Tankers are still doing relatively well. I know that's a ton mile issue, blah blah blah, but
Well,
you
but
know,
it still tightens up supply of freight, and therefore freight gets supported and moves higher. I mean,
yeah,
I made the call earlier that we'd see doubling in freight values from $30,000, and I think we've hit that number a bit sooner than I
well,
thought we'd hit it, but we've hit that number now. When you look at the forward
okay.
FFA rates.
Yeah, just sticking on freight then. So, just moving topic slightly, same thing. How is it panning out in terms of who's allowed to move cargoes, what cargoes you're allowed to move, where you can call if you call Russia? And I'll use an example. There was a vessel this week that called Fujairah. A large owner who won't be named, just because it's not fair, because they're not here to answer, called us Luga and St. Petersburg, co-loaded, went down to Fujairah, discharged. This is a sizable owner. Can that ship go into, say, Northwest Europe and load a cargo without having to answer loads and loads of questions on why they're loading from Russia?
Under the price cap mechanism rules, if you're a ship holder, all you're required to have is an LOI from the person who has chartered your vessel to say that they're moving oil under the price cap. Now, if that is all that's required, and you present that when you're going into your next port of call that happens to be in Europe, then it really depends on the local jurisdiction and what they are going to say about how they're going to treat that ship. But from what I understand, that if you have followed the rules of the price cap trade and you've loaded a Russian cargo under the price cap, you've shipped that Russian cargo to another port, you've discharged that cargo, now you're coming back to load a new port into an EU port, as long as your documentation's in order, you're fine. You haven't violated any rules.
And can you, so
now,
that fixture, that
some
fixture.
Companies have,
yeah, go on, sorry.
And I'm not going to name companies, but some companies have put constraints on they are not going to utilize a Russian vessel unless that vessel has done other trades outside of Russia for X amount of days. So you might not find somebody who's willing to charter you to go load a cargo until you've done something else outside of a Russian trade.
Right. The person chartering that ship can't be within the EU, UK, US, anyone who's applied the sanctions. The charterer can't be based in London, pick up the phone saying, I want to load, I've got a cargo I need to load out of Russia. Or can they, if they say it's part of the price cap?
I don't know about the individual jurisdictions, i.e. a UK trader in the UK doing this business or not. Under the price cap mechanism, you're allowed to use EU services and UK services. So that
you can pay in euros or sterling. Pay
your
the freight.
Your P&I club, your broker, freight services, all that can be done under, as long as it's done under the price cap and the documentation's in place and it's done accordingly to that mechanism. If you try to trade outside of that and not use it, then you're probably going to run into problems.
Okay, but you can't pay for the freight in dollars.
No, you can. If you're doing it under the price cap, you have to have the documentation that you've done this under the price cap. And each tier level inside of the trade flow has their own set of requirements that they must maintain to show this trade was done legitimately under the price cap mechanism.
Right. So, okay. So you're a charterer working for a trader that's sitting in London. You've bought a cargo of Russian oil and you've sold it into a company based in this instance, Fujairah in the UAE. But you can't discharge that cargo within the EU, US, UK, any of that.
Right, because it's embargoed into the UK and the UK, United States, Canada, EU, Japan, all have, and Australia all have a physical embargo against Russian oil imports. Period.
Gotcha. Okay, that makes sense. But Edwards, I sense a little bit of ambiguity in your words there, my friend.
How so?
Well, because it all seems to be, obviously, but no one is 100% sure on it. That's what I mean. So let's say Euronav or whoever it might be okay, I'm loading some Russian crude. I'm going to discharge it into India, and then I've got a fixture that I've got a service in the Gulf Coast, and I'm going to send that ship to the Gulf Coast. There is a little bit where everyone's going, yeah, but can you send it to America?
Well,
is the Coast Guard going to arrest?
There, as long as you have the documentation, because if you made that move and you're doing this on the up and up, your AIS is going to be on. People are going to track that ship from point A to point B, from point B to point C. You show up into point C. Will you most likely have a port state inspection? You most likely will. Will you have to produce the documentation to show, hey, I did this all under the price cap? You most likely will.
Right, gotcha. Okay. So Russian oil is allowed, but only up to $60 on crude and $100 on products.
$100 for gas oil, or positive margin material, and $40 for negative margin material.
Right. So your naphthas and your fuel oils.
Correct.
Okay. So the oil is moving. So, okay, then answer me this. Then people are worried about supply issues, but they don't have to be, because Russia can still export the material anyway.
Yes. Now, the problem you have with Russia and their exports is getting themselves constrained in their port facilities, because their port logistics were not designed for long haul transits of products. They were designed to dump products into Europe. And so they don't necessarily have the tank capacity to handle, large lead times and getting material from a refinery in Siberia to Ust-Luga, and then loading a ship from Ust-Luga to go all the way down to West Africa, where that ship would normally load in Ust-Luga and go to Poland, or go from Ust-Luga to Rotterdam.
Right, gotcha.
And so that's where Russia's problem actually comes in logistically, is that they don't have the full infrastructure, at least as far as I can recall, to handle longer lead times of products exporting out. To me, it's kind of like that 500,000 barrels per day of production cuts that Russia announced last week, and why that's become quite the damp squid.
500,000 barrels a day,
Is that really going to be, or is the market going to lose 500,000 barrels a day of actual crude supply? Or is it 500,000 that went to a refinery that has to shut down now because they can't get their product out, or multiple refineries can't run at full rates because they can't get all their product out?
Yeah, I think what that is, to me, the number I largely dismissed. It was more, I think, that got the market's attention, because does that signal some kind of split for OPEC plus? If Russia have no choice but to adjust energy policy purely because they don't have the infrastructure, as you said, or they're having to shut down because people are just not able to buy the product, so some crude oil's got to be shut down. I think the market is absorbing that as, is this a change in policy from OPEC? Because they've been aligned for the last 3 years since COVID, really.
They've been aligned, but you also look at the timing of when the production cut is happening. It's also aligning with their maximum refinery turnaround period as well. Their maintenance period starts usually in March and April, as well as field maintenance in the different oil fields. So there's a lot of things that, is this 500,000 barrel cut, just part of their normal operating procedure that happens when you look at the history of Russian oil production? Or is it something larger? Because the cut's only for the month of March. It's not like they didn't say we're cutting for the rest of the year.
No, sure. But I mean, I think that if they did that, then that would certainly have had a market reaction.
Yeah, well, if they said we're going to cut 500,000 barrels for the rest of the year, that's one thing. We're only cutting it in March.
Yeah.
Which aligns with a lot of other things that go on within the Russian energy sector. And it could be just, trying a way to goose the market a bit to show that we're serious about what we can do, and here's what we're going to do. But we do this normally anyway, because we have all this maintenance that we have to get done, and that actually impacts our oil production. Now, when you look at it from an OPEC plus perspective, remember, OPEC plus is still underperforming against their own quota by about 1.8 million barrels a day.
Yeah.
So all this does is say, oh, okay, we're bringing ourselves closer to reality of what actual OPEC production is. versus the headline number that they keep spouting that this is what we're supplying to the market, but that number has never been hit yet. So that
Yeah.
production cut just brings that 1.8 to maybe 1.4.
Yeah. No, you're right. I mean, I can't, I mean, you know, I read a story or heard a story this morning that the energy markets, most of them, grain markets, ags markets, are no longer in this distressed place. The market has corrected itself and things have returned to normal, whatever that is in the energy market. I don't know. I would argue, if anything, this year has been a dull one for energy markets. Things have, like I said earlier, things have stayed in a relatively weak range. Cracks are down. Demand isn't as good as people hoped. I think it's probably been a brutal start to the year for most people because, like I said, things haven't panned out. But I think it's calm before the storm. I really do. I haven't changed my outlook on that. I still think whether the supply shocks will be as dramatic as many people feared, no, probably not. But there will certainly be some effect at some point. I think, like you said, stocks in ARA are high. Once we start drawing on them, you know, then it will be okay. Where are those trading patterns? Where is the material coming from? Like you said, it's a trader's sort of dream is to, and probably the biggest one in my 23-year career in the energy markets, of new trading patterns have to form because Russian oil is sanctioned. And I think that if you're a trader, it's first come first. You know, it's whoever finds that trading pattern first, and the most efficient way to do it stands to make a lot of money. So I think that the rest of the year will be a lot better than it's been so far.
I don't know. I'm still of a case that I think that interest rates continue moving up, which are going to put a big headwind against any further moves up in crude outside of a major supply shock. I think that's the only way you get crude up to 100, back to 100 again, is you have a major supply shock somewhere, i.e., you know, Russia cuts 2 million barrels of production directly to the market, direct export to the market, or something happens in the Middle East to set off a conflagration, which then reduces flow to the markets. I think overall consumer demand in the EU and the US is not as strong as it could be. I mean, you look at gasoline demand numbers in the United States for the first 8 weeks or 6 weeks of the year, and probably below 600 to 700,000 barrels a day lower than normal.
Yeah,
and this is even in pre-COVID. I think so far we've only averaged about 8.1 million a day of gasoline demand in the United States, and normally it should be about 8.8 this time of year. So that's a pretty telling sign, and this is even with prices lower than where they were this time last year. So
just in the UK,
it's not so much a price number; it's more of a you know, consumers trying to figure out how they can manage the inflation and the cost of living increase.
Yeah, I mean, I've just seen the UK PMIs come in, pretty good. Composite PMI is 53, 49 forecast, which is good. Signals growth, and anything over 50 is growth. Manufacturing PMI was forecast to come in at 47.5. It came in at 49.2. And services PMI forecast 49.2, came in at 53.3. So, you know, there's a lot of positives going on as well. It's like you said, it's what happens vis-a-vis fiscal policy. I mean, the big ones that people got to look out for the rest of the week. We've got Q4 GDP.
You've got US, well, that's the second reading on the Q4 GDPs. That's just going to be whatever adjustments they're going to make from the Bureau of Labor Statistics. You've got US PMI data out later today, which is going to be the counterpoint to the UK and EU, because even the EU's PMI data came in above 50, which was above expectations. Asian PMIs, however, are not looking so hot. Australia came in a bit lower than expected. Japan came in lower than expected. So it's almost like you're losing those driving engines in Asia, supplementing that with the recovery in Europe, which, granted, with lower energy costs, European markets should recover or come back to some modicum size of growth, because with nat gas prices coming off so much, that's a big driver for a lot of industry.
Yeah, I think you're right.
And if you don't have that headwind of higher cost structure, then things should perform okay.
Yeah, look, I mean, cable again. You know, looking at market indicators, cable's been flirting just above 120 recently. I thought it might have a bit of a pop based on those PMI numbers, but I don't know. No one seems to want to make a move until data. You know, it's fiscal policy. What happens with interest rates? Have they capped out? Recession. Largely, it seems that it's been avoided. You know,
or it's being ignored in the case of the U.S.
Or it's been ignored. Here he goes. Or you've got what happens with Russian energy. So I think, look, listen, viewers, we're not here to read the same script every week. It's just it's going to start getting spicier a lot sooner than later, a lot sooner rather than later. I think just because of when the Chinese data comes in, what happens with Russian energy? Where is it going? Is it just going dark? So yeah, like, comment, subscribe.
Well,
and yeah.
In closing, there's always the expectation of what the market's going to do, and then confirmation when the data comes. And if the data doesn't conform with the expectation, pretty soon those expectations need to either start adjusting towards the trend line of the real data. Otherwise, you start skewing yourselves on your expectations being well above where the actual performance of the market sits. And so as long as you still have these forward projections of robust growth and robust development in Asia, you're going to have an upward bias in markets. But then as the real data comes in and it shows you, well, we're building stocks, we're doing this, we're doing that, demand is lower, it will eventually adjust, and those forward expectations will come off or start aligning with the past data as more data comes in.
Yeah.
But that is all we have time for today, everybody. So thank you very much for tuning in. As Matt says, like, subscribe, comment, and we'll look forward to you next week.
Ciao, ciao. Ciao, ciao.